Hey, this is Chris from StockSpot. In this video, I'm going to be talking about gold. Now, gold has had an unbelievable run over the last 15 months or so, and it's lately trading at about 3,200 US dollars an ounce, which is 5,200 Australian dollars an ounce. That's up over 70% since the start of 2024, so it's an enormous run. It's seemed to be the only defensive asset left out there, given that US government bonds have been selling off on fears of the impact of tariffs and inflation on their economy. And so everyone's been gravitating to gold as this defensive asset. What we've been seeing in the StockSpot portfolios actually over the last few weeks is some rebalancing out of gold. The reason for this is that gold as an allocation in our portfolios is 14.8%. But because it's gone for such a stellar run over the last year, that percentage has increased in a lot of client portfolios up towards 20%. And at that point, our system has basically said that gold is too big an allocation in these portfolios and needs to be rebalanced back to that 14.8%. And that money is then used to reinvest into some of the asset classes that have done not as well over the last year, including Australian shares, which has fallen now about 17% from its high to its low of the last couple of weeks. So what we're seeing is actually some selling out of gold. More broadly, what we're seeing is that the big investment banks have been upgrading their gold price forecasts. So even 24 hours ago, Goldman Sachs upgraded their forecast to $3,700 an ounce, which is another 15% up from where it is today. There's obviously a lot of excitement and euphoria at the moment around gold. Sorry for interrupting, but I'd like to take a moment to talk about my channel. Now, most people who watch my videos don't subscribe to my channel, which means that they don't find out about other videos I'm making, and it doesn't share the love with others who are interested in investing. So if you are interested in videos like this, I would encourage you to please subscribe to my channel so you find out more about the videos we're making here. One of the reasons we're a bit more cautious is that there are a lot of potential catalysts for gold to have a pullback. One would be just an easing of the trade tension, tariff tension that we're seeing in markets at the moment. If the US steps back on their proposed trade tariffs, then a lot of this money that's been flowing into gold as a safe haven might need to come out. Just generally, there's a lot of retail money in gold at the moment, which often is a precursor to a bit of a sell-off as well. And another potential catalyst for gold to pull back a bit would be a recoupling of gold to real interest rates, because what gold typically does is it trade in line with real or inflation adjusted interest rates. There's been an enormous divergence between these two over the last little while as people have lost faith in US government bonds. But if US government bond yields continue to rise above 5%, it may actually lead to a sell-off in gold, because government bonds at that point will become pretty attractive relative to gold. So I think there's a few potential clouds on the horizon that could lead to a sell-off in the vicinity of 15 or 25% this year after such a stellar run. And that's what I'd be looking for if I was a long-term investor that didn't currently have an allocation to gold, but was looking to get an allocation. Rather than chase the excitement and heat now, I'd either be dollar cost averaging over the next 6 to 12 months or waiting for a bit of a pullback to buy when there's less euphoria around. If you are, however, someone that already has an allocation to gold, like the StockSpot clients that have a 14.8% allocation, I would let the system rebalance that allocation back down to what it should be if you've got a bigger allocation because of that market growth. And I wouldn't be tempted to add too much more at the moment. I think a 14.8% allocation is a great percentage to have in gold. Because of this big run, it's added about 6 or 7% in returns to each of our portfolios over the last 12 months. You know, that's a great extra bit of buffer these portfolios now have against market pullbacks. But I wouldn't be chasing this after a 70% run over 15 months. An asset like this, even though I think it's a fantastic long-term investment, is potentially due for a significant pullback, and that's what I'd be looking for before buying in more gold.